Alright, hello and welcome to Camel Finance. I'm your boy Camel and it's nearly Christmas. I think I was saying in a video a couple of days ago that normally by the time we get to about the 15th of December, I take about 4 or 5 weeks off and I will come back around the second week of January. That's my routine for Christmas. Obviously this year is my first Christmas with a YouTube channel. So today I'm going to just spend a little bit of time of explaining why I don't really trade during this period. There's likely going to be minimal trading from me. So I'll show you how I see it at the moment. I'll show you what I'm sort of expecting to see. I'm actually not really expecting the market to do anything spectacular during the Christmas period because many of the Wall Street traders will be on holiday. A lot of the liquidity is removed from the market this time of year because traders just aren't at their desks. And so I'm not really expecting anything too wild or significant to occur in the charts. That does mean that likely the content I'll be producing will be much more news-based. If there's anything major that happens to the charts, I will of course update that. If I change any of my positions or decide to take any new positions, I of course will update you on that. But likely we're just going to be making some nice chilled content over the next 4 weeks, lots of news, and then we'll come back and be a full-time trader again as of the new year. Talk about disconnect. I want to talk about the disconnect because something is lying, okay? Either the stock market is correct and bonds are lying, or it's the other way around. So I'm going to prove that to you using the Fed funds rate and a couple of charts for the bond yields. So I'm going to show you that and we'll try to figure out, really we can't figure out which one's lying. The market will have to tell us which one's lying, but one of them is certainly lying. And lastly, I kind of just want to remind anyone who is the sort of person that watches charts every minute of every day. If that happens to be you, just remember to enjoy life, okay? Because the charts are still going to be there when you come back in the new year. Christmas, however, you have to wait another year for, right? No amount of money, no amount of trading, no amount of gains, no amount of profit, no amount of mastery of skills is worth not spending quality time doing something you like, spending quality time with people that you have in your life, okay? However limited they may or may not be. Whether you're into Christmas or not, whether you celebrate Christmas or not, at least use this time, whilst liquidity is going to be removed from the market, at least use this time whilst the price action is kind of irrelevant, because what will actually matter is when the Wall Street traders come back in the new year, that price action will carry far more weight than anything that happens between now and then. So whether you celebrate Christmas or not, whether you have a lot of people around you or not, just remember to take some you time, okay? Take some quality time doing something that you like that isn't staring at charts. These charts, they cannot rule your life and they will be there in 4 weeks' time when we come back. So the internet's favorite fractal is back, and you can see here, the question is, are we going to do this? Are we going to do this? And the answer is, I don't know, and neither do you. We just have to see what the market does over the coming weeks. I've of course been showing this meltup thesis, which at the moment, it could go either way. It's gone from being my primary thesis, as I said, to this is no longer my primary thesis. I'm back to neutral, meaning I don't really know. If we get more downside price action, then I will quickly flip bearish, and bearish will become my primary thesis, and this will become the secondary. It's always possible that we could do something like this, okay? Now, admittedly, I don't like that. I don't like that because this is moving the goalpost. This is not what I predicted, but we also can't rule this out, especially if the price starts to round over the holidays and then we come out of here nice and strong. We don't make a new low. Then perhaps this is the case. Admittedly, like I said, I don't like to move the goalpost, but we certainly can't rule that out. I've also been pretty consistent on this channel in saying that whilst I thought my primary thesis was that we would have a melt up and then go full Great Depression, Great Reset, I also said that if for some reason the price told us different and we ended up coming down here and taking those lows, then likely we've already seen the top and we're going to go full Great Reset, Great Depression straight away. So maybe that is going to be ready to greet us in the new year. Maybe that's what we've got to look forward to in January. So I would much rather see something like this play out. But given where the S&P chart is right now, given that we've had this cycle, it came up, it took out that cycle low, I have to admit that the only way I can really read this chart is to expect further downside. Now, does it have to take out the low? No. Could it form up here? Absolutely. Could it form way down here? Absolutely. Anything's on the table. And like I said, there's not going to be much Wall Street action. There's not going to be much volume relative to normal because it's the Christmas period. So anything that happens in the meantime is somewhat insignificant and could certainly be dwarfed by January when the real volume returns to the market. One more point I'd like to make about the stock market is there's always a chance that this could form a swing low. Now, again, I don't like moving the goalposts, but if the market on Monday was to shoot up here and recover this low that it's taken out, and we should close a green candle up in this neighborhood here, then I would be happy to say that we have a late cycle low and this was a bear trap. Now, I'm not saying that's likely, but I'm saying it's one scenario that could be a case. However, if anything other than a big green candle that comes back inside this range happens on Monday, then it is most likely that we are going to be proceeding down into the next cycle low, and this counts as a very early day 4 high, waiting for another 36 days of downside into this cycle low here, wherever it forms. Bitcoin is worked out quite nicely for the holidays. I think it's safe to say that we're not going to recover the spring I've been talking about. I think it's safe to say that we've got a day 35 high in play, and therefore we're going to be working our way down to the 60-day cycle low due around the 6th of Jan. That's absolutely fine for me, because that means I can just AFK here. I don't have to worry about keeping an eye on the Bitcoin price. I of course will be keeping some level of watch over this, but most probably now we can safely say that we are going to trend down into a 60-day cycle low due around the 6th of Jan, plus or minus 6 days, and then look for a swing low. And once we get that swing, I believe that will be the chance to go long and strong. And finally, then we can get full exposure to Coinbase, MicroStrategy, Riot, Marathon, all of these sorts of things. I'll add an Ethereum trade back, and we'll look to see what the market can give from there. If I hop into the Dow chart here, you can see we have indeed held this line. So it doesn't mean we can't be weak on Monday, but it also doesn't mean we couldn't bounce off of here, and this couldn't end up being a bear trap where we move the cycle low, like I said. Now again, I don't like that idea. I don't like to move the goalpost, but if the market tells us that is what's going on, then we have to respect what the market is saying. Next, I want to talk about the disconnect between markets that I mentioned and bonds at the beginning of this video. We have the TLT breaking out. Okay, this is the price of the TLT breaking out, which means the yields are coming down. So is this about to become a failed breakout? Does that mean these TLTs are going to roll over and this is going to become a bearish cross on the MACD, and therefore yields are going to spike and risk is going to come off, meaning we can expect further downside in the stock market? Is that what's going to happen? Or was this really a bear trap? Are the TLTs going to continue their upside, meaning the yields are going to come off, and is this going to bounce and become even more bullish on the MACD? Because if that's the case, then we could expect risk on and perhaps that melt up to be saved after all. Now again, I'm not predicting anything. I'm simply telling you I am neutral at the moment, and I am looking for the market to give me the price action that will tell me which direction we're going. I know this looks like we're going down, but no one can say with certainty we're going down, just like nobody can say with certainty that that must have been a bear trap. I'm saying I'm neutral at the moment, and I don't know. So the next thing I want to talk about is the US government 2-year bond yield, which is calling a Fed bluff. It's calling the Fed's bluff and saying, we do not believe you, and you're going to have to stop hiking rates. You're going to have to pause hiking rates. Now, this is not me predicting this. This is the bond market. So in green here is the US government 2-year yield, and in orange here is the federal funds rate. Now, if I go to a weekly chart and I zoom out, you can see here that going back all the way to 1989, when the Fed funds rate crossed above the 2-year yield on the bond, the Fed had to pause hiking rates. And this is the same story here. Once the 2-year yield fell below that of the Fed funds rate, the Fed moved to a pause. The same is true here. The Fed paused rates once the Fed funds rate crossed above the 2-year yield. You see it again here, a Fed funds rate pausing the rate hikes once the Fed funds rate had moved above the 2-year yield. We saw this again in 2018 going into 2019. And fast forward to today, we have that exact same scenario occurring today. We have the Fed funds rate, which has just crossed above the yield on the 2-year bond. This chart suggests that we are going to see a pivot to a pause at the next Fed meeting. This is not me saying this. This is the bond market calling the Fed's bluff. The bond market is telling us, hey, you've over-tightened now. You've over-tightened and you have to stop. Said another way, we may have just seen the last rate hike. This is not me telling you I think they're going to pause rates. This is the bond market saying to the Fed, we want you to stop. And whenever it's said this historically, as I showed you by zooming out here, whenever this has happened in the past, this is exactly what the Fed has done. The Fed has stopped hiking. So when I said right at the beginning of this video that there's a disconnect, either stocks or bonds are lying, that means either the stock market did indeed experience a bear trap and is going to recover swiftly as the Fed pauses, which we know is the most bullish part of the hiking cycle, or we're about to see the yields break out massively. That includes the 2-year as well. We're also about to see the TLT roll over and a massive risk-off event is going to occur, possibly fulfilling this fractal. So one of these two entities is lying. I don't know if it's the bond market or if it's the stock market. Neither do you. But that is what I'm going to be looking at to become clear in the new year. I'd like to also point out this piece of information that I wasn't aware of. Stocks tend to bottom on the December the 15th, and then the seasonally strong part of the month begins. So hopping back into the S&P chart, you can see that December 15th was the Thursday. So does that mean this could actually end up forming a swing and a cycle low? Of course, I'm not speculating. I'm just saying that remains to be seen. And of course, that could be invalidated if we continue lower on Monday. Milton here thinks that as of today's close, this is going back a couple of days ago, it's likely that this pullback is corrective in nature rather than continuation of the bear market. He goes on to show you a bunch of times that during a bull market where we had big 5 to 10% corrections during an uptrend. So you can go and read that in your own time if you're interested. It's just an idea. Henrik here says everybody is now bearish. There's no Christmas rally because instead we're going to have a crash. But he says, guys, wait, wave two, count the divergence. He thinks we're going up on Monday. That remains to be seen. I have no strong opinion. I'm just going to let the market tell me what to expect. Something that is quite interesting is we have had a breakdown retest looking for the resumption off of this on the VIX chart. If I hop into my VIX chart over here, which I've been showing for a while, you can see that whilst the hedge has been put back on, this did not spike massively. This did not spike, indicating fear. So is this just a move into resistance? Is this just a flip of what was prior support turned resistance? And does this mean that the stock market can actually produce some upside going forward? Again, I don't know. I'm just trying to let the market let me know. Something that we know is correlated to stock market performance is the job data. And the reason for this is because the Fed has told us they want to see unemployment rise so that they could feel more confident about reducing the velocity and the aggression with which they are hiking interest rates. Whilst the official data that came out last week showed unemployment to be less severe than anticipated, it's also come to light that likely this has been overstated by at least 1.1 million jobs. So the question is anyone really surprised that job data released before the elections is turning out to have been faked? Well, I'm not. As long as reverse repos are elevated, risk assets are a buy, according to James here. It means institutions have a ton of extra liquidity, which they don't want to lend it to someone else other than the Fed. So does this mean we could see this liquidity put to work? Does this mean we could see risk come on in the new year? Of course, that remains to be seen for now. Over in the Bitcoin world, this poll here was very interesting to me. The question is, at what price do you need to see Bitcoin for you to be all in with no money left in stablecoins? And you can see that 2/3 of the market wants $10,000 or lower. 20% of the market, 1 in 5 people want 5,000 or lower for Bitcoin. Now, I just don't think those people understand Bitcoin, because at that price, the network is in danger. The network is in severe danger because of the miners. The hash rate will drop massively. The possibility of a 51% attack becomes massively elevated. So I don't think these people really understand Bitcoin. The reason I flag this is because 2/3 of the market think we have to go lower. So therefore, does that mean max pain is to the upside? Potentially. Regardless of price, Bitcoin continues to be adopted. And here you can see someone purchasing groceries for Bitcoin in South Africa.
I'm going to pay with Bitcoin?
QR payment.
QR payment. I'm on my crypto QR because this is the thing that they require for payments and app. No KYC. It's here. Come here. Oh, it's a QR payment. And now watch. It's detecting. Oh, right. I'm going to open my wallet, Moon.
Okay, and then
you can see my... No, look at me. Okay, I opened my wallet. Oh, it says pick and pay. Pay 63. 0 network fees. And that's it. I go to send.
0 network fees.
And it's sent. Should receive it? Receive?
Not yet.
Not yet? Yes, there. Yay. All right. Thank you.
Easy as
There you
that.
go. And I'm gonna just...
I love to see it. I hope you do too. The market's still very, very uneducated. And Will Clementi pointed this out very beautifully. He says it's pretty funny that over $100 million worth of BNB, that's Binance's coin, open interest has built up on Binance, which is presumably mostly shorts based on the funding and the price context. But here's the thing, if you're betting on Binance's demise, if you're betting on the collapse of Binance Exchange, why would you bet on it on Binance? This is analogous to shorting the FTT token on the FTX exchange. Of course, if they go bankrupt, you're not going to be able to take your profit out because the exchange is going to have collapsed. So it just goes to show that people aren't really thinking. They're not really thinking. They still don't really understand this space. And that's understandable because it's very new. It's very complex. But I thought that was funny. I'd like to remind you of this. just before I say goodbye. Look, the Bank for International Settlements, which is the central bank boss, the central bank to the central banks, now allows banks to use permissionless blockchains and hold 2% of their tier 1 capital in Bitcoin. This means they view it the same as gold. Tier 1 capital is the same as what has been allocated to gold. 63 central banks representing countries that account for 95% of the world's entire GDP are now able to hold Bitcoin. If you found value here today, I'd appreciate it if you could drop a like on the video. Subscribe if you're not already. I will be posting content most days, I think almost every day. I don't see why not. The schedule at which I upload might sway around a bit. I imagine sometimes it will be early in the morning, sometimes it will be in the afternoon. So bear with me. I hope you have a wonderful Christmas time or holiday period. I hope you can get away from the charts. They'll still be there in the new year, like I said. It'll be interesting to see what happens in the charts tomorrow, if anything. I will continue to update as always. In the meantime, I hope you're doing well in life. Look after yourselves. Take care from me. All the best. Cheers. Bye.